Okay, hello everyone. So we are back with Ian Sterling from OSL, who will be moderating a fireside chat with Dave Olson of Jump Trading.
Thank you, Henry. I think over the course of our time together today, we've had the opportunity to hear about the rapid growth of the sector, about regulations and expanding product shelf. I think it's really fitting to punctuate our forum with the tale from curiosity to experiment and ultimately into market leader through the experiences of our next speaker. And so it's a great pleasure and a delight to introduce Dave Olson. Dave had a storied career with JP Morgan before moving over to proprietary trading firm Jump Trading, where he's currently the president and chief risk officer. Whilst he didn't make the jump for digital assets, he's been instrumental in leading the firm's foray into that space. And I think, I hope at least from the session, you'll be able to identify with a number of the steps that Dave has taken as you embark on or continue your own journeys to digital asset discovery or adoption. So good evening, Dave, and thank you for joining us. I think, like all good stories, it makes sense to start from the beginning. So maybe you can offer some color around your transition to Jump, a little bit about the business, and the nature of what spawned the curiosity into digital assets and ultimately into experimentation phase.
Yeah, sure. Thanks, Ian, and to the entire group. Really happy to be a part of this evening here in New York and whatever time it is, morning predominantly in Hong Kong and everyone else that's dialed in. So really thrilled to be a part of this. Yeah, I've been at Jump about 4 years now. And when I arrived in 2016, you're quite right. I wasn't drawn to Jump because of what was happening in digital assets. I was more drawn to the company that I had grown to know during my time at JP Morgan, the management team, how they behaved in both good times and in crises, and what was happening with the real move toward data science and using much more sophisticated modeling tools to predict value in financial markets. But it so happened that just as I was arriving at Jump, we were incubating in what was more or less a talent development program that we had initiated in collaboration with the University of Illinois, a chance for students there and potential prospects to work at Jump to build out infrastructure and model high performance gateways and sessions with a lot of the burgeoning cryptocurrency exchanges around the world. The thinking then being, this was when Bitcoin was still triple digits. There wasn't enough volume to really get on our radar screen as an institution. It was an incredibly fragmented market built by very creative entrepreneurs. These are all the exchanges and marketplaces where you could trade digital assets at that time. But none of them really had the same toolbox that had been used in modern financial markets. So our thinking was, you take this young talent, have them cut their teeth on developing high performance connectivity to these venues with all of their idiosyncratic requirements. And if they ever came to work at Jump and they had to use modern fixed tools and exchange protocols, it would be a piece of cake. Little did we know that we were wiring together a level of global connectivity that just a few months later would become incredibly interesting and incredibly valuable to us. So it was, I won't call it entirely an accident, but it certainly wasn't part of some long-term vision that we decided to invest all of these hours in developing these capabilities.
That's quite interesting that really the origins were not necessarily preserving your market leading edge in the prop trading side of the business, but it was about retaining staff and good talent on that front. So clearly the market leadership position did not come up just overnight. But through this experimentation, or at least scratching the itch on the curiosity, going into experimentation, and you recognize that you're onto something, and that whilst you're in green fields, this is when the trailblazing begins. Maybe you can share a little bit about that that experience, especially when you think back to those years. There is no playbook. There is no manual for you to follow. You have to really create your own framework around compliance, risk, operations, etc.
Yeah, those were pretty exciting days, and that was when you had a lot of value discrepancy between venues. You had a very broken movement of fiat around the world. You had a lot of correspondent clearing banks abruptly shut down some of the fiat rails with no notice. You had behavior where you would send an order, you would then send a cancellation of that order, you'd get an acknowledgement of the cancellation back, and then you'd get a fill for the same order. And you think, what in the world is going on here? It was very unfamiliar relative to most of the markets that we participate in. But we really had a dual objective back then. I think, of course, we wanted to follow our nose to where the opportunity was, try to make money and trade in as liquid a way as possible. But you bring up compliance and trying to construct a framework where one didn't really exist. We made a second distinction that we wanted to make sure that our behavior, even if permissible under the letter of the law or because a regulation had not yet been written, was not going to be adversely affecting the entire ecosystem. So privacy tokens are a good example of that. There's a lot of buzz around Monero when it first came out. It looked like it was going to be certainly a top 10 coin and maybe on its way to even higher levels. And we took a stance as a company that even though we might be able to stake a claim and become a top liquidity provider in a privacy token, it was worth foregoing whatever revenue would accrue to us from that, while the regulatory landscape for that sort of instrument had just not been formulated, and you had the potential for something to go pretty wrong. Even though we had counsel suggest, no, you've got a credible defense if it ever came to that, because there's really no specific reg around this. We tried to play a longer term game and not cut the market out at the knees while we were trying to build a business. I'd say the other big distinction back in those days was we weren't overbuilding based on some dogmatic view of how financial markets were going to change. We had a very incremental approach where we wanted to invest resources and really demonstrate there was a profitable, sustainable business for us, and then reinvest and grow from that standpoint. As you might know, we also get involved in early stage investing through Jump Capital, which is a captive venture capital company that we run. And we would sit down with entrepreneurs and say, can you survive if the latter half of 2018 just goes straight into the future? And many of them were banking on the exponential growth really taking off to bail out their business model. And I think staying a little bit smaller than we perhaps thought was going to be our endpoint, but being able to continue to grow organically through all the twists and turns of this market was something that we were pretty comfortable with.
It's incredible to think really how much ground you're able to make up in such a short period of time whilst you're playing for the long-term game. You've really sort of achieved that market dominance really quickly, and it's evidence that this sector advances and evolves extraordinarily quickly as well. And how have you seen the industry change over the past few years? And certainly, as we're based here in Hong Kong and majority of the callers or the audience are from Asia, how has the emergence of Asia factored into the growth of your business as well as the industry as a whole?
I mean, there have definitely been distinct phases, and our participation in this market comes many, many chapters in from the real pioneers and the really early innovators that we tip our hats to, that were using very cutting edge maneuvers to try to acquire coin, and hopefully they kept it. I've got a lot more respect for the people that maybe they bought it at $1 and didn't sell at 10 and held on for the entire ride than just buying. I'm not sure I would have had the same degree of commitment and patience. But when we entered, as I mentioned, the market was very fragmented. You had enormous, unpredictable arbitrage that was manifesting itself all over the place, largely due to the relatively immature state of the post-trade environment. You had most exchanges, most venues on which you could trade required pre-funding and offered no leverage. So if you wanted to buy 1,000 Bitcoin, you had to have the fiat in their account under your name, ready to go, much like a lot of venues continue to work today. And if that venue started to have the cheapest price and you wanted to buy more, but you didn't have the funds available, you had to wait for the international wire process, which can be multiple days, to replenish your buying power. So the trades themselves, if you're a trading firm, were not complicated at all. Bitcoin would get tens of dollars, in some cases hundreds of dollars, disconnected from the cheapest to the richest venue. So we spent a great deal of time on really trying to understand and develop the post-trade architecture. Some on the call may remember Noble Bank during its period in this market from 2017 through 2018. It ended up the business didn't work out for them, although nobody lost money that banked them. They were really the first fiat escrow agent that allowed for 24/7 journaling of funds, and was the predecessor to what we're seeing from Silvergate and Signature and some other banks fulfilling the same role now. So as soon as that happened, the market immediately went to be a nearly zero arbitrage environment, or on the order of modern markets, with prices on one venue versus another trading within a tolerance that would be made up by the fees you would have to pay to do it. So there, it really went into many more modern trading strategies. You would try to do price prediction. You would make very tight liquid markets. We saw a lot of spread compression. And your question about Asia, I think that the moment that we've arrived at now and have been at for some time is really driven by Asia. It is a regulatory framework that allows retail participation and leverage to be combined. And we've seen some of the perpetual swap venues and some of the levered offerings in Asia really take hold and create most of the global liquidity and price leadership in this market. There's no question Asia is seen as where the action is, and we're no different in recognizing that right now.
You put a nod out to the pioneers. I've sort of classed you as a trailblazer yourself. The funny thing is there's still very much so a first mover advantage available to be seized. What do you see as the biggest obstacles for institutional adoption and really taking and grabbing that?
Yeah, I think that we've removed the most substantial obstacles. I think there was a period of great vulnerability probably in 2018 where you had the potential for the G20 to come together and really deliver a very difficult blow to the digital asset market. I think we're over that hump from the standpoint of the global regulatory community worrying about, should we allow this to exist? They probably recognized that was not within their power, but now we're on the backside of that. And I think that we're seeing a lot of those obstacles chip away. I agree with you. It's still extremely early. There's a lot of first mover room left. But banking, accounting, and sophisticated custody solutions that verge into prime brokerage. I think you get those three pillars underneath this table, and you'll see the institutional interest, and as Tom said in the earlier panel, a lot of new participants coming into the market really start to come in with both feet and material amounts of capital.
I think we have time for one last question. It's be a two-parter, but I'll just pause for a second to highlight a couple of the key takeaways that I'm gathering from this conversation. It's been fantastic. Thanks, Dave. Number one, there's still very much a first mover advantage available. So go out and grab that, depending on whatever phase you're in and considering if it's still just curiosity or if you're into experiment phase or if you're actually gone to market. I think with that as well, people really do matter. Entrepreneurship and fostering that sort of environment internally will certainly help you and pay dividends later. And if not, seek out good quality partners to be able to achieve that, whether that's through academia or commercial entities. And lastly, I guess from an Asia perspective, this is the growth engine. I think everyone hears that, certainly in traditional finance, regardless of whether you're investment banker, private banker, asset manager, Asia will continue to be that. So finally, Dave, I think if this forms any indication that the worlds of digital assets and traditional finance seem to be far more harmonious and symbiotic than one may have believed maybe even a year ago, do you believe that fintechs in this space are now being seen, or maybe even more so acting more as facilitators rather than disruptors? And then how does that bode for the future of capital markets?
Yeah, look, I think there's a spectrum, of course. You've got some very traditional approaches by some fintechs. Libra's come up a couple times tonight. That could be extraordinarily disruptive globally. And the new East Asian stablecoin that's gotten some press this week. I think we're talking about a fundamental reshaping of the way money is used in society. Hard to be more disruptive than that. I think about Bakkt and what they're doing, trying to create a fluid wallet for many different types of digital assets, not just cryptocurrencies, but everything from World of Warcraft swords to frequent flyer miles to Bitcoin that you could use to buy a cup of coffee. We're really at the starting point for innovation with the digitization of money. And I think that the fintechs that I would imagine that are going to be the FANG stocks of the digital currency movement may be companies that we don't even know the names of today. I think it's that early, and it's absolutely exciting to be playing some role in this type of evolution. So looking forward to what's next.
Thanks, Dave. Back to you, Henry.
Thanks so much, you guys. Some fantastic insights. Dave, you had me at World of Warcraft swords there. I'm more of a real-time strategy game player myself. So thank you again to both of you. And we have one more event coming up. We have our closing remarks with David Seymour, the CEO of Wave Financial, in about 5 minutes. So thank you so much.